500 years ago, China was the largest economy in the world. No other country came close. The last 100 years have been a relative anomaly when it comes to China. History has rarely seen a weak Chinese state existing for more than a century. With the country's communist system reforming in the late 70s, China's sheer economic potential in the modern world has been essentially unlocked. The dragon has risen, as they say. But how was the dragon awakened, and how may its fires affect the rest of the world? Well, that's what we're here to find out. Before we start though, make sure to like this video, subscribe to our channel, and click the notification bell for new updates. Done that? Let's get into it. President Mao Zedong's death in 1976 was arguably the most significant event in contemporary Chinese history. Following that, in 1978, China began to open up and restructure its economy. Since then, GDP growth has averaged about 10% per year, with more than 800 million people pulled out of poverty. Over the same time span, there have been tremendous gains in access to healthcare, education, and other services. The party leaders resolved to embark on a program of gradual but significant economic reform during the landmark Third Plenum of the National Party Congress's 11th Central Committee, which convened on December 22, 1978. They came to the conclusion that the centrally planned economy had failed to create efficient economic growth, causing China to slip well behind not only the developed nations of the West but also the emerging Asian industrial giants. While Japan and Hong Kong equaled European countries in modern technology in the late 1970s, China's inhabitants had to make do with scarce food supplies, rationed clothing, inadequate housing, and a poor and inefficient service sector. All of these flaws made China look bad in the eyes of the rest of the world. China is now classified as an upper-middle income country. Going forward, it will be critical that poverty alleviation initiatives progressively focus on the vulnerabilities faced by the significant number of individuals still considered poor by middle-income country criteria, including those residing in cities. China's rapid growth, which has been fueled by resource-intensive manufacturing, exports, and low-wage labor, has mostly reached its limitations, resulting in economic, social, and environmental imbalances. To address these inequities, the economy's structure must transition from low-end manufacturing to higher-end manufacturing and services, as well as from investment to consumption. Because of its size, China is at the center of major regional and global development challenges. China is the world's greatest emitter of greenhouse gases, with per capita emissions currently surpassing those of the European Union, although being slightly lower than the OECD average and far lower than the United States, and its air and water pollution has an impact on neighboring countries. However, without China's participation, global environmental and economic problems will remain unsolvable. Furthermore, maintaining adequate economic growth has substantial spillover effects on the rest of the international economy. As of 2010, China's real estate market was the world's largest, accounting for over 20% of the country's GDP. According to the People's Bank of China, the PBOC, direct real estate investment would reach RMB 7.5 trillion renminbi, or RMB, which is the equivalent of $118 billion in 2020, accounting for 7.4% of GDP. The construction industry, which is based on real estate, added another RMB 7.3 trillion, or $115 billion in to GDP in that year, according to data from the National Bureau of Statistics, NBS. According to Ren Ziping, chief economist of Suchao Securities, a financial services organization, real estate will account for 51.5% of investment in fixed assets countrywide in 2020, with real estate development accounting for 27.3%. Despite not being one of China's largest employers, the property industry is responsible for a large number of jobs. The construction and finance businesses employ a big number of people and are heavily reliant on the real estate sector's health. The construction industry's employment peaked in 2020 with over 62 million people. When you factor in industries like wholesale and retail, which are reliant on property holdings, ownership, and distribution, a number of individuals whose livelihoods are reliant on the real estate sector grows even more. Recognizing the economic risk posed by the property sector's debt, The People's Bank of China and the Ministry of Housing and Urban-Rural Development convened a conference with other government agencies in August 2020 to propose ways to limit borrowing and reduce debt in the property sector. 12 of China's major property developers were present at the conference, and they were asked to take steps to reduce debt. The discussion resulted in a policy known as the Three Red Lines. Property developers must meet certain conditions before applying for refinancing under this regulation, which has not been made public. The following are the three red lines for real estate companies: an asset-liability ratio of no greater than 70%, a net debt ratio of no more than 100%, a cash-to-short-term debt ratio of 1 or below. All of the developers present at the meeting crossed at least one of the red lines at the time of the meeting, with the exception of two, one of whom was Evergrande. Most people were able to stay within the boundaries a year later to apply for new loans. Evergrande, China's second-largest property developer at the time the crisis began, has suffered greatly as a result of the Three Red Lines policy. Evergrande's liabilities totaled approximately $300 billion, including $19 billion in offshore bonds. This meant that 1 year after the meeting, Evergrande had crossed all three red lines and was unable to repay or refinance its debts. Evergrande defaulted on $1.2 billion in offshore bonds in December of 2021. Although this did not necessarily indicate that the company was on the verge of bankruptcy, it did raise questions about the company's capacity to fulfill the remainder of its debts. In addition to institutional investors, it's likely that the company won't be able to meet its obligations for unbuilt home advance pre-sales or compensate home buyers if the homes are never built. Evergrande isn't the only property developer to have run into debt as a result of the new laws. Kaisa, a property developer, failed a $400 million bond payment at the same time as Evergrande. Shimao Group defaulted on a $101 million project loan in January of 2022, while Yusao Group has requested a postponement for repayment of their $582 million in offshore bonds. According to several observers, China's issues will remain in China because the Xi Jinping government will contain the problem before it causes damage to the banking system. They also claim that the problem will not spread to the rest of the world's financial system. However, according to a new investigation, this is not the case. According to a forecast by UBS, if the property market collapses further, it may knock $1 trillion off the worldwide market. According to an article in The Telegraph, while the International Monetary Fund anticipates worldwide growth of 4.9% by the end of 2022, UBS estimates that a battered Chinese property market will shave 0.5 percentage points off the rate. The world economy is valued at $95 trillion. If the crisis intensifies, that figure might quadruple. The foreign junk bond market in China has taken the brunt of the impact. Junk bonds are bonds that have a higher chance of default or non-payment than most corporate and government bonds. Some investors purchase junk bonds to profit from possible price increases when the underlying company's financial security improves, rather than for the return of investment income. A sell-off in this market has wiped almost a third of investors' wealth in the last 6 months. Furthermore, if the crisis develops, businesses will restrict construction and banks will refuse to lend while they restructure their damaged balance sheets. Households in China will be hesitant to take out new mortgages. Last year, household debt increased from $2 trillion to nearly $10 trillion. According to Oxford economics researchers, China's property collapse would be limited, but China's massive property sector could crash more dramatically due to changing demographics, higher numbers of unoccupied apartments, and some significant property developers being heavily over-leveraged. One, it might set off a big domino effect among builders, which is already manifesting itself in the economy. According to experts, every company that declares its inability to repay debt encourages others to follow suit. As demand for construction materials, autos, and machinery fall, this distress could spread to other sections of the global market, such as commodities and raw materials, via import-export channels. The crisis, especially in Beijing, has had an impact on the millions of people who work there, causing economic shockwaves. As a result, Home sales are down and the building is slowing. This is a negative influence on vehicle and retail sales. As a result, if China purchases less steel, it may have a negative influence on the world economy. As China's domestic demand declines, the economies that are most vulnerable will suffer the most. Chile, Brazil, Australia, Korea, Taiwan, Malaysia, and Vietnam are among the economies with the largest market exposure. The U.S. Federal Reserve has expressed concern over the sector's turbulence. The Federal Reserve of the United States cautioned that the Chinese housing market's woes could affect the U.S. financial system. It said in its latest financial stability report that, quote, stresses in China's real estate sector could strain the Chinese financial system, with possible spillovers to the United States, end quote. It pointed to the size of the Chinese economy and global links. A housing market collapse in China might result in job losses, stock market declines, and deflation. According to a CNBC report, all of these factors could put a strain on global trade channels since China will have to restrict commerce with other countries to some level. China's economy is intertwined with the global economy, and a collapse there could spread to other countries. However, the research stated that a level of fallout of this magnitude is implausible. China has a good chance of minimizing the disaster, but it must act quickly because investor confidence is suffering. China's property market in 2022 and in the future will be largely determined by the policies implemented by its government. In a report released in December 2021, the People's Bank of China predicted that for 2022, property investment would expand between 2.5 and 5.5%. Even the more hopeful end of the range, however, is still far below the 7% year-over-year investment increase seen in 2020. That's all for today. Let us know what you think of the Chinese housing market bubble and its future in the world economy. As always, thank you for watching, and remember to like this video, subscribe to our channel, and click the notification bell for new updates. We'll see you again next time.